Right now, the world feels like it's on fire. War in the Middle East. Oil prices spiking past $80 a barrel. Inflation fears creeping back in. And yet, the Dow just closed at a record high, above 52,000 points. So, in the next 10 minutes, I'm going to show you exactly why that's happening, the four forces that actually move stock prices, and who really benefits when the market climbs while everything around it looks like it's falling apart. By the end, you'll never read a stocks hit record highs headline the same way again. Here's a question for you. If a friend told you the world was in chaos and then told you their investments just hit an all-time high, would you believe both things at once? Most people wouldn't. But that's exactly what's happening right now. And the reason comes down to one mistake almost everyone makes. We assume the stock market is a scoreboard for the economy. Good news, it goes up. Bad news, it goes down. It sounds obvious. It's also wrong. Here's a better way to picture it. Imagine the stock market isn't a mirror of the world. Imagine it's a machine, sitting in a locked room that only cares about four things: future profits, interest rates, where money is flowing, and what large investors are being forced to do right now. In this exact moment, that machine has no idea what war feels like. It has no idea what your grocery bill feels like. It just runs the math. And once you understand that, the confusing headline stops being confusing. Let's start with profits, because something strange is happening right now that most people have completely missed. We're in the middle of earnings season. More than 86% of S&P 500 companies just beat expectations. That's a huge number. So why is the market still punishing some of them the very next day? Here's the twist. Beating expectations isn't the story anymore. Investors aren't asking, "Did you make money last quarter?" They're asking, "Prove to me you'll still be making this much money 2 years from now." Miss that proof, and even a great quarter gets sold off. That single shift explains almost every, "Wait, why did that stock drop?" headline you've seen this month. Now here's where it gets interesting. Picture the S&P 500 as a classroom of 500 students. You'd assume every student matters roughly the same amount to the class average, right? They don't. In this classroom, about 7 students are so enormous that their grades alone can move the entire average, while the other 493 barely register. So, when the news says the market hit a record high, what it often really means is a handful of giants had a great week. Your rent didn't get cheaper. Your grocery bill didn't shrink. The market was never grading that in the first place. And here's the part almost nobody explains, the part I actually spend my time studying. A huge amount of daily trading isn't done by humans anymore. It's done by algorithms. Now imagine a line of dominoes, except each domino is a trading algorithm, and they're all watching the exact same price level. The moment a stock crosses that line, the first domino falls. It buys. That purchase pushes the price up just enough to trigger the second domino, then the third. Within seconds, you have a wave of automatic buying that started from a single price tick, and no human being decided any of it in real time. Now stack options traders on top of that. When enough people bet a stock will rise, the firms selling those bets often have to buy the actual stock just to protect themselves. So one small piece of good news can trigger 3 separate buying machines stacking on top of each other in minutes. That's not optimism. That's dominoes falling in the dark. By the way, if this kind of breakdown is actually useful to you, hit like. It genuinely helps this channel more than you'd think. Here's a strange truth about human psychology, and once you see it, you can't unsee it. Markets don't only rally because news is good. They rally when news is less terrible than everyone braced for. Imagine walking into an exam convinced you failed. You're expecting a D. Your teacher hands it back, and it's a C-. Objectively, that's still not great, but it feels like a win because your brain was comparing it to disaster, not to perfection. Investors do the exact same thing. Traders were bracing for oil routes shutting down completely. Instead, we got a partial de-escalation. The situation is still bad, but compared to the nightmare everyone priced in, it feels like relief. And relief moves markets just as hard as good news does. So if profits and psychology don't fully explain it, what does? Follow the money. Literally, during every crisis, governments pump enormous amounts of cash into the economy to stop it from collapsing. Some of that money reaches regular people, And here's the key detail most explainers skip. Regular people spend it on rent, on groceries, on fixing the car. But a lot of that same money eventually lands in the hands of people and institutions who already own assets. And wealthy institutions don't spend extra cash the way you or I would. They buy more assets with it. Stocks, real estate, private companies. More money chasing the same limited pile of assets does exactly what you'd expect. Prices climb. That's a huge, quiet reason. The market keeps setting records, while affordability keeps getting worse for everyone else. If you already own assets, this makes you richer without lifting a finger. If you don't, the gap gets a little wider every single year, automatically. There's one last piece, and it's the one nobody wants to say out loud. Trust in cash itself is quietly eroding. The US government is carrying tens of trillions in debt, and a huge slice of the federal budget doesn't even go toward paying that debt down anymore. It just covers the interest, just the cost of carrying it. In a world like that, sitting in cash starts to feel like a losing bet. So money moves into stocks, into real estate, into gold, into anything that feels more solid than currency sitting still. So here's the real question, the one that headline never asks. Not, why are stocks at record highs? But who actually wins when they are? The faster asset prices climb, the faster the distance grows between people who own assets and people who don't. That's not a conspiracy hiding in the shadows. It's just math, running on autopilot, at a scale most of us never get to see. So the next time you see stock market hits new record flash across your screen, don't ask if that's good news or bad news. Ask this instead. Who was already standing on the right side of the machine before it started running? If this helped you see the market a little differently, subscribe so you don't miss the next one. I'll see you there.